In March of 2026, a group of investors tried to do something simple. They asked for their money back. They had put their savings into a private credit fund, the kind marketed as safe, steady, and boring, a fund that pays out dividends every quarter like clockwork. Nearly 17% of the fund's investors wanted out at the same time. The fund only let them take 5%. The rest are still waiting. That's not supposed to happen to a safe investment. So what's really going on underneath? To understand it, you need to follow a $1 trillion market that barely existed 20 years ago, and that most people have never heard of, even though it might already be sitting inside their retirement account. This is private credit, and right now it's showing cracks that the industry keeps insisting aren't there. Let's start with the basic idea. Private credit is lending that happens outside of banks and outside of public markets. A company needs money. It's too big for a small business loan and too small or too complicated for a traditional bank or a bond sale on Wall Street. So a private fund steps in and lends directly. No stock exchange, no public price, just a contract between a borrower and a lender. For years, this looked like a genius idea. Investors got higher returns than regular bonds. Companies got fast, flexible financing banks wouldn't offer. Everyone was happy. But there's a catch nobody talks about at the pitch meeting. Most of these loans are floating rate. That means the interest rate isn't fixed. It moves with a benchmark rate set by the market, one tied closely to whatever the Federal Reserve is doing. And here's the part that matters. From 2022 to 2023, the Fed raised rates faster than almost any point in modern history. Borrowing costs across the entire economy jumped. For a company with a fixed-rate mortgage-style loan, that's irrelevant, nothing changes. But for a company with a floating-rate private credit loan, every single rate hike landed directly on their monthly bill. Their debt payment didn't just go up once, it kept climbing every time the benchmark moved. Now picture a mid-sized company that took on a large floating-rate loan back when rates were near zero. The math worked fine at first. Then the benchmark rose from near zero to over 5%. Suddenly, the same loan cost several times more to service every month, with no change in the company's actual sales or profits. That's not a hypothetical. It's happened to real companies across the private credit world, in software, healthcare, retail, and manufacturing. Some make it through, some don't. This isn't the first time hidden leverage has caused a crisis nobody saw coming. In 2008, the danger wasn't that people borrowed money. Borrowing is normal. The danger was that risky loans got packaged, repackaged, and spread through the financial system in forms so complex that almost nobody could see how much danger was actually sitting on the books. Private credit today doesn't have the same structure as 2008's mortgage bonds, but it shares the same core problem, a huge and growing pile of debt, priced and monitored mostly by the very people who have a financial interest in it looking fine. Most of the companies now defaulting are true middle-market businesses, earning under $100 million a year, carrying under $500 million in debt, with almost no protection against rising rates. These aren't giant, closely watched corporations. They're the kind of company most people have never heard of, quietly borrowing billions in total, one deal at a time. And the numbers are moving in one direction. Fitch's tracked default rate for U.S. private credit hit 5.8% through January 2026, the highest since the firm started measuring it. Inside the riskier, privately monitored slice of that market, the rate hit 9.2% for 2025, a new record, up from 8.1% the year before. Separate research firms are seeing the same trend from different angles. One index tracking nearly 700 loans worth over $189 billion found the default rate nearly doubled in just 6 months. That's not noise, that's a pattern. LSTA. So why does the industry keep saying private credit is healthy? Because there's a tool that makes bad loans look good on paper. It's called payment in kind, or PIK. Normally, if a borrower can't make their interest payment in cash, that's a default. Red flag, everyone can see it. A PIK loan changes the rules. Instead of paying interest in cash, the borrower is allowed to add the unpaid interest onto the loan balance. No missed payment shows up. No default gets flagged. On paper, everything still looks fine. But the lender still reports that unpaid interest as income, even though no cash actually came in. Public business development companies, the funds that let ordinary investors buy into private credit, are now pulling an average of 8% of their reported income from PIK instead of cash. That means a real slice of the profit these funds report to investors is money that was never actually collected. Van Eck. This is where psychology comes in. Nobody in this industry wants to be the one who admits a loan is failing. Marking a loan down means reporting a loss. Reporting a loss scares investors. Scared investors ask for their money back. And a fund that can't sell its illiquid loans quickly can't easily hand that money over. So the incentive, quietly, is to delay. Extend the loan. Offer a PIK option. Keep the number looking stable one more quarter. This isn't necessarily fraud. It's often just human beings avoiding an uncomfortable truth for as long as they possibly can. That pattern has a name in finance: extend and pretend. And it shows up in almost every credit cycle in history, because avoiding short-term pain is a very human thing to do, even when it makes the long-term problem worse. Here's the financial lesson underneath all of this. These private loans don't trade on any public exchange.
There's no daily price you can look up. Instead, they get valued using internal models and assumptions, updated only once every few months. In accounting terms, this is called a Level 3 asset, the least transparent, most opinion-based category that exists. When an asset is priced by opinion instead of by an actual buyer and seller in a real market, it can look stable for a long time, right up until it suddenly doesn't. That's the real risk in private credit. It's not that these loans are guaranteed to blow up. Many won't. It's that investors often can't tell the difference between a fund holding genuinely healthy loans and one quietly leaning on PIK and generous valuations to hide stress until redemptions get frozen or a wave of defaults hits at once. So what does this mean for you, practically? Non-bank lenders, including private credit funds, now hold more debt than traditional banks do. This market has grown large enough that many retirement plans, insurance products, and income-focused funds now include private credit exposure, sometimes without investors realizing it. Creative planning. Before you put money into anything marketed as a high-yield private credit or direct lending fund, ask 3 questions. How much of the fund's reported income is coming from PIK instead of cash? How easily can you actually withdraw your money? And what are the limits if many people ask at once? And who is pricing these loans? An independent party or the fund manager grading their own homework? None of this means private credit is doomed or that every fund is hiding something. Most loans in this market are still performing exactly as promised. But higher for longer interest rates have exposed real weak spots, and the industry's own numbers, not outside critics, its own numbers, are climbing toward multi-year highs. The bond market, the credit market, the loan market, none of them announce a crisis with a press release. They send small, quiet signals first.
A redemption request that doesn't get filled, a quarterly default number that ticks up again, a PIK percentage that keeps creeping higher. History keeps teaching the same lesson, in different disguises each time. Debt problems rarely announce themselves loudly at the start. They get managed, delayed, and reclassified until the math simply runs out of places to hide. If you're investing in anything you don't fully understand, that's usually the moment to slow down and ask more questions, not fewer. The loans in this story looked perfectly fine for years, right up until they weren't.